Here's the top 10 high-income list that I shared in April 2023. Those are my largest positions, and they make up half of my portfolio. But what about the other half? Today, I'll show you the full list of 37 positions and how to access your own copy with updates. After 2 months of travel, mostly in Vietnam, it's good to be back home. On the flight back, I was thinking about how to share my portfolio. That's because when I uploaded the top 10 video, I received a lot of requests for the full breakdown. The challenge is that it's a long list. If I spend 2 minutes on each of the 37 stocks and funds, the video would be over an hour long, and frankly, neither of us want that. So here's my solution, ranking them by weighting. Numbers 1 through 10 you've seen before if you watched this video. I'll link that in the description for those who haven't seen it. Today, though, we'll focus on the next largest allocations, numbers 11 through 20, and then I'll quickly show you the numbers 21 through 37. I'll also show you how to get your own copy of the portfolio, which also contains these handy links to the relevant videos. Number 11 is a preferred stock, AGNCN. Preferred stocks have a limited upside. They usually don't go much above $25, but their dividends are more consistent and reliable than regular stocks. This particular one was issued by a mortgage REIT called AGNC Investment. Would I buy regular stock in this company? No. One look at their dividend history shows it's trending in the wrong direction. If we look at the dividends from the preferred stock, though, they're trending the right way. So why do they move in opposite directions? The regular stock, also known as common stock, pays distributions based on the current financial health of the business. If earnings are down, the board is likely to trim the next dividend. Preferred stocks are more like a loan that must be repaid first, in other words, before the common stock dividend. The amount to be paid isn't based on the current financial position of the business, it's based on the terms defined when the preferred stock was issued. In this particular case, the AGNCN preferred stock was issued with a fixed yield of 7%, which means 7% of its face value of $25. We can see the consistent 7% yield was paid here. Some preferred stocks switch from fixed to floating, and that's why the dividends started climbing here. AGNCN is currently floating, and that's at 5.4% above the secured overnight financing rate. So that means if interest rates drop, that fat 10% plus yield will also drop. You may be wondering, why would this company want to pay such a high yield to shareholders? And frankly, they probably don't. Well, maybe when they issued this one, they didn't think that rates would climb so high. Who did? Important to note that this preferred stock is callable, which means that the company could force preferred stockholders to sell the shares back to the company at $25. So obviously you don't want to pay much more than $25 for this one. If this all sounds complicated, now you know why everybody doesn't invest in preferred stocks. There's a lot to learn, there's a bit of monitoring to do, and they don't really do that well when interest rates are climbing. I've invested in a few because I want to learn more about them, but my largest preferred stock allocation is to the PFFA fund. They actively manage almost 200 preferred stocks, as explained in the top 10 video. And frankly, they're 100 times better at it than I am. By the way, if you're new to the channel, I retired in 2017, and that's when I got serious about researching my investments in greater depth because now they pay for everything. I mostly focus on stocks and funds paying consistent yields of just over 8%. Number 12 on the list is another preferred stock, and it was issued by Annaly Capital, another mortgage REIT. This highlights another issue with preferred stocks. They're not diversified across business sectors. You're almost always investing in the finance sector. Would I buy Annaly Capital's common stock? Well, let's look at the dividends. They're trending down, so no, I wouldn't. By investing in these preferred stocks, I'm not thinking these companies will be the most profitable businesses in their sector. I just need them to survive. If the business faces hard times, the regular dividend could be reduced or even suspended, but the preferred dividends would only be affected if the business was in serious financial trouble. If you love analyzing numbers and want to learn about preferred stocks, I recommend reading the 67-page guide to investing in preferred shares. It was written by a newsletter I subscribe to called The REIT Forum, and it's by far the best introduction to preferred stocks I've found anywhere. I'll include links in the description to the guide and a discount for their newsletter. The guide is free. Number 13 is QQQI, a covered call fund based on the NASDAQ 100 index, and it's yielding about 14%. Its closest competitor would be JEPQ, which is currently my highest allocation. The only reason this fund has a smaller allocation than JEPQ is that it's newer. If QQQI continues to perform as promised, I'll increase the allocation. Even though JEPQ and QQQI are both based on the NASDAQ 100, there are some differences between the strategies. Those differences were the topic of this interview with Garrett, who co-founded NEOS, the fund manager for QQQI. If you're not familiar with covered call funds, I've mentioned them a few times. You can just check out this video for an explanation of how they work. Number 14 is a business development company, or BDC. It's only been around since 2021, but it's operated by one of the largest asset managers in the world, Blackstone. BDCs don't get much love in the investment community, but I think that's changing, and Blackstone's entry adds some credibility to this sector. Number 15 is a closed-end fund specializing in boring old utilities. UTG is yielding about 8%, and it's boring, I think, in a good way. It's been pumping out consistent distributions for more than 20 years, and those distributions have been growing slowly but surely. It uses some leverage, about 20%, which is relatively low by closed-end fund standards. Higher interest rates have made that leverage a bit more expensive, which reduces their profitability. In other words, interest rate cuts would be good for UTG. Number 16 is another BDC. It's Capital Southwest, and that one has been on a tear. In fact, the only reason I don't hold more of its stock is because the price, frankly, went up too much. Here you can see Capital Southwest's pattern of growing its regular dividend and also paying a substantial number of special dividends. As an income investor, that's usually all I could ever hope for from an investment. But lately, the price of this one has gone bananas. The past year has been fantastic for the S&P 500 because of all that AI-driven tech boom. Meanwhile, Capital Southwest has delivered a total return of more than double the S&P 500 while paying a yield of more than 8%. And that's frankly insane for a company that's just in the lending business. Nothing to do with AI. It's a great company, but it's priced now for perfection. If future earnings reports are only good but not great, the price will probably correct. So I trimmed it back to a bit less than 3% of my portfolio. Number 17 yields more than 13%, but I've never mentioned it on this channel. It's a closed-end fund from one of the best fixed income fund managers in the world, PIMCO. This is the company that Howard Chan worked for before founding KURV, as we discussed in a recent interview. I may review it in a future episode, but I've been putting it off because it's just so complicated. This summary of the business by Simply Safe Dividends gives you an idea of just how complicated. You can screenshot it if you're interested in reading it, but the short version is a lot of different fixed income investments and instruments in multiple currencies and countries. I have reviewed number 18, FEPI, FEPI, and much like QQQI, it's lower on the list because it's so new. It's another covered call ETF, but this one is hyper-focused on tech. It only holds 15 tech stocks. The yield so far is extremely high, more than 20%, and because it's concentrated on tech growth, the price is quite volatile. If it continues to deliver high yield and can even just maintain its NAV, I'm open to increasing my allocation to this one in the future. Number 19 is a mortgage REIT that pays almost 10%. The Starwood name may sound familiar because it's run by the guy that created W Hotels under the Starwood umbrella of brands. His name is Barry Sternlicht, and he's a fascinating CEO, as I mentioned in the review of his company. He sold Starwood Hotels to Marriott, so this company has nothing to do with his former business. Starwood Property Trust, this one, is a lender that specializes in real estate loans. The distributions haven't grown recently, but they do have a long record of consistency. The last one we'll look at today is Hercules Capital, ticker HTGC. Similar story to Capital Southwest in that it's a BDC that has outperformed the S&P 500 recently. Not quite as much as Southwest, but impressive nonetheless, and paying a healthy distribution. While Southwest lends across a diverse cross-section of the economy, Hercules Capital is far more tech-focused with its loans, which does add some concentration risk. Let's talk allocation, how much to buy of each of these, or at least I can tell you what I've done. The top 10 investments are roughly 5% each, so that's 50% of the portfolio. The next 10, which we looked at today, adds up to almost 30% of the portfolio, so that means the top 20 are roughly 80% of the portfolio. I currently hold 37 positions, so the other 17 investments, which I won't be covering today, are much smaller. Those 17 combined make up just 20% of the portfolio, give or take. They're a mix of higher risk investments or positions I'm transitioning in or out of. I've come to realize that all these stocks and funds and videos that I'm making can get a bit overwhelming, so I've decided to format them into a simple list called Armchair Insider. It shows how much I've allocated to each investment, and if I've reviewed it, you can access the video by clicking the link in the right-hand column. I plan to send this out once a month in case you're interested to see what I'm holding. It's much easier to update this spreadsheet than make a video every time I buy or sell something. I basically went into my Snowball account, clicked here, and it produces a spreadsheet with tons of data. To clean it up, I pasted just the yield and the allocation into a new spreadsheet so that I could add the links to the videos. I use Snowball to keep track of my current and future income so I know what's coming in over the coming days, weeks, and months. There's a link in the description for a free trial and a discount. Back to this portfolio. So how do you get a copy? Well, it can be yours for the low monthly cost of... I'm just kidding. There's no Patreon, no Discord. It's free. Just click the link in the description and I'll email it to you. Technically, it's a newsletter, but I won't be writing long-winded, fluffy stuff. It's mostly just going to be the updated portfolio. And if you get sick of receiving my updated portfolio each month, there's an unsubscribe link at the bottom. What should you do with this list? Well, I'd prefer if you didn't just blindly copy it. I've been hesitant to share lists like this because I don't want you to think I'm telling you what to buy. I'm not. These investments work for me, but not for everybody. You could get more growth from growth stocks, obviously, or safer dividends from dividend aristocrats. But if, like me, you want a consistent, high-income stream, then perhaps a list like this can help you find some new ideas that work for your portfolio. If you want to learn more about any of the stocks and funds that I mentioned today, there are plenty of detailed articles on Seeking Alpha about, well, all of them, frankly. I'll put a link in the description for a free trial and a discount. Or you can watch this top 10 playlist that contains detailed reviews of each of the top 10. That wraps it up for this portfolio reveal. More Armchair Income coming soon.